Welcome to Retirement GPS, navigated by Zynergy, your roadmap to a secure and confident retirement. Each week, we explore strategies, stories, and planning frameworks designed to help you navigate the complexities of life after work. From tax planning to investments, income strategies to risk management, our goal is to give you the clarity and confidence you need to make informed decisions. But retirement isn't just about the numbers. It's also about lifestyle, purpose, and peace of mind. We're here to guide you through both the financial details and the personal dimensions of this next chapter. Let's chart today's course.
Welcome back to our Retirement GPS podcast. We are now on episode 50, and I'm your host, Ryan Zacharczyk, certified financial planner and president of Zynergy Retirement Planning. And I'm really excited today to talk about one of our probably most highly used, certainly most sophisticated tax strategy that really anybody out there, anybody listening who has a taxable investment account can use, and that's our tax loss harvesting strategy. It's really a way that we can turn a negative, which would be the market volatility, i.e. the market falling, in a way to save you money. The way most people view losses is that they see losses in their accounts as a frustrating thing, especially in a taxable investment account. And they say, oh, the market's falling, my account's worth less than it was yesterday. And it's understandable. But what sophisticated investors and planners know is that market declines, especially in taxable accounts, can lead to opportunities. We want to try to make lemonade out of those lemons when they do present themselves and when we have that opportunity. Instead of focusing on the temporary loss, what we ask, is there any opportunity here that we can take advantage of? And tax loss harvesting is one of those opportunities. It's a way to potentially convert temporary losses into future tax savings. And the key word here is temporary. We're not talking about abandoning your investment strategy. We're not talking about strategically lopping off half of your portfolio, i.e. your arm, to save the rest of the body. No, we're talking about strategically managing taxable investments to improve after-tax outcomes. So what is tax loss harvesting? What is this strategy that you've heard about? How does it work? So this strategy is simple. Suppose you have purchased an investment for $100,000. And then you go through a pretty rough market environment, and that investment falls to $80,000 in the short term as volatility hits us hard. You have an unrealized loss of $20,000. Many investors would simply hold on to that investment, waiting for it to recover and say, I need to get my money back before I want to sell. But there is another option available. Here, what we're going to do, and what we typically do at Zynergy, is we will sell that investment, realize that $20,000 loss and for tax purposes, and then reinvest the proceeds into a similar investment to maintain our market exposure. We haven't necessarily changed our investment strategy, but we've created a tax asset, right? We've created a loss that now we hold in our pocket. That $20,000 loss can potentially be used to offset gains now or in the future when we do recognize gains from the sale of growing assets. And that process is called tax loss harvesting. Now, a couple things to keep in mind here. It's really important. Number one is that this can only be done in a taxable account. If you're trading in an IRA or a Roth IRA, a 401k, tax loss harvesting doesn't work. Why? Because there are no capital gains or capital losses to be harvested in these accounts. These are tax deferred. They're only taxed in the case of an IRA, traditional IRA, or a traditional 401k when the money is taken out. And in the case of a Roth IRA, they're never taxed. So giving this example is not a good idea in an IRA because you're not going to get this benefit. Another thing to consider is that we want to reinvest in something similar. The example I like to use often is if we're invested in our total bond index in our portfolio and bonds fall and we're down money, we have a loss, we can sell the total bond index and go buy a midterm treasury portfolio or a treasury fund. And it's very similar in risk profile, very similar in interest that's paid, but they are materially different funds. Because they're materially different, we're going to get that advantage of the tax loss harvesting, but we're also going to maintain our bond exposure because we're going to do the trades almost instantly, sell to take the loss, and then purchase the new fund right away. Now, you cannot, I repeat, sell a fund and buy the exact same fund back to recognize that loss. So I cannot go out and sell Nvidia because I lost money in it and then turn around and one day later buy it because I want to have it back, but I recognize the loss, right? There's what's called the wash sale rule by the federal government, which means if you repurchase the same asset or materially same asset within 30 days, you're going to negate that trade and you will not get that loss recognized. Your basis will carry forward to the new purchase, okay? That's called the wash sale rule. It's also true of, they call it materially similar investments. So that would be something like an S&P 500 fund. If you sold a Fidelity S&P 500 fund and bought a Schwab S&P 500 fund, you haven't done anything different. You have materially the same investment, which means you're going to trigger the wash sale rule. Okay, so make sure that it is materially different. Make sure it's a different type of investment. They can have very similar risk profiles. They just have to be different. And like I said, in the case of a total bond index, which has all kinds of different bonds, and then an intermediate treasury bond index, they are materially different funds. Same risk profile, but materially different. So the IRS does not trigger the wash sale rule. Why tax losses have value. So let's talk about what are the benefit of my tax losses. Many people don't realize that investment losses can actually really become valuable. They think of a loss almost like a coupon that can be redeemed against future taxable gains. For example, if you later sell another investment and realize a $20,000 gain, your harvested loss will completely offset that gain. So even though you really haven't changed your portfolio or done anything different, that loss that you took now becomes valuable to offset that $20,000 gain. If you're in the 15% capital gains bracket, you're looking at a $3,000 tax savings simply by recognizing the loss that can then offset the gain. Instead of paying taxes on the gain, that loss absorbs it entirely. And the other thing is you can offset $3,000 of ordinary income tax. So if you have earned income and you have a $20,000 loss, $3,000 of that loss can go against your earned income, which is really valuable as well. Whatever you don't use will then carry forward, all right? So it'll carry forward for you to use in future years. Let's use a real world example here. What do we want to do and how do we want to use our loss? So let's say Susan owns several different investments in her taxable brokerage account. During a market decline, one holding falls by $50,000. Rather than simply waiting for the market to recover, she harvests the loss and ultimately takes the money from that investment and reinvests in something materially similar. So sells an S&P 500 fund and buys a total market index fund. Okay, very similar investment, but they are materially different. Rather than simply waiting for the market to recover, she harvests that loss, and a few years later, she sells another investment for a $50,000 gain. Because she previously harvested the loss, the gain can be offset, even though it was a few years ago. Depending on her tax situation, she can permanently save thousands of dollars in federal taxes. The market recovery may have happened anyway, but by taking action during the downturn, she can add additional value to that decline. So again, we're taking these lemons and turning them into lemonade. Tax loss harvesting is not market timing. I want to be really clear about that, right? We're not saying that we're going to try to time the market. No, we're simply recognizing that the market's falling. The example I like to use is saying to a sailor, if you're going to change your sails when the wind changes direction, you're not timing the wind, right? You're not saying, I think the wind's going to blow this way this time, so now I'm going to change the sails. No, when the wind changes, you change your sails, right? When the market declines, this is a strategy that we have in our pocket that we can use to create a coupon, a tax loss coupon, that we can use to apply to future gains, to future credits. But it's an important point that when we see this happen, we take advantage of it. We're not proactively trying to time the market. We are reinvesting and getting our portfolio back in line immediately with a materially different fund. Then after 30 days, if there's either no gain in the new fund or there's only a slight gain or even a loss, we can then sell the fund and then put it back into the original investment. So think of it as this example. If I own the S&P 500, it falls $20,000. I sell it. I buy the total market index and I hold on to that for 30 days. The market really hasn't moved or even a little bit lower. I can then sell the total market index and buy the S&P 500 back. Okay, and all those losses stay with me. Now I have my original portfolio back. If the total market index increases dramatically because, hey, listen, the market's volatile, so it fell, and now it rallied right back, and all of a sudden now it's back to where it was, then hang on to the total market index at that point. Okay, so we can hang on to that as our new investment in that portfolio. We discussed the wash sale rule, so remember, do not buy the exact same fund back within 30 days. If you do, it will be disallowed due to the wash sale. Who benefits most? Not everyone benefits equally from tax loss harvesting. The biggest beneficiaries are often investors who have, number one, you have to have a taxable brokerage account, right? So if it's not taxable, then it really doesn't work. Number two, meaningful capital gains. So you know you're going to have meaningful capital gains in the future. Again, you can offset up to $3,000 of ordinary income. So if you have a $9,000 loss, even if you don't have material gains over the next 3 years, you can offset that and reduce that loss against ordinary income. If you're in a high tax bracket, obviously it's a huge value for you. So if you're paying more than 15%, if you're paying 20% capital gains or high ordinary income bracket, that's going to be a much larger benefit for you than someone in a lower bracket for sure. And if you're a long-term wealth accumulator, so if you have a long-term time horizon, the more opportunities there may be for tax loss harvesting, right? You're going to sit through a lot more market volatility, and each time it comes, you should be harvesting those losses. So make sure that you're taking advantage of all these things, but there also are mistakes that you want to make sure you avoid. Let's talk about mistake number one, waiting for the market to recover, right? If the market falls, and you say, well, I'll wait till I'm back even, and then I'll do my tax loss harvesting. Guess what? You have no losses to harvest. So you need to take advantage of the biggest losses. When are the biggest losses? I can't tell you. Again, that is market timing. We just want to take advantage of losses when they seem large enough to go through the hassle. Maybe a $1,000 or $2,000 loss isn't big enough for you to justify the time and the effort. Maybe a $10,000 loss certainly is. So why wait till it becomes a $15,000 loss? Let's just trigger it at 10. Take the loss. We can always take more losses in the future if the market keeps falling. Number two, triggering wash sales, right? Big mistake. We talked about that. We don't want to trigger wash sales, so make sure that we're investing in something materially different. And looking only at taxes. Taxes matter, but the investment strategy matters more. So make sure that just because you have a great tax strategy, you're not making a poor investment decision. I always tell people here at Synergy, the investments, the risk management, that comes first. The taxes come second. We want to make good decisions based on the investments and the risk management first. If we have to pay some taxes, we pay the taxes. But if all things are equal and we can make a good tax decision, then we'll do that. Now, why this matters for retirees, because this is really valuable. Most people think it's only valuable for young people who are dynamic or have big portfolios, but it really is important for retirees because a lot of retirees that I work with are constantly liquidating to draw from their portfolio to live and to transfer that money into their checking account. So by having a tax loss coupon that you harvested during a down market, if you are selling things that are doing well during that period where you're liquidating for your income, then you can offset it with the tax loss. Rebalancing is also important for anybody, retirees included, but we have to rebalance. So this gives us an opportunity to potentially rebalance during a loss. Capital gains realization, so it offsets all of those capital gains we talked about. And then tax bracket management. This is really effective for tax bracket management because, as we've talked about in prior podcasts, your tax bracket affects a lot of other things, such as your Medicare premiums, how your Social Security is taxed, and of course, your tax brackets, which is how much your next dollar is taxed. If we can take some losses and keep your bracket under control, we can reduce all of these things. So the bigger lesson here to consider, and the thing we want to think about, is that volatility isn't always the enemy. Markets will fluctuate. They always have, and they always will. But periods of volatility often create planning opportunities. Most investors see nothing but losses. Sophisticated planners look at opportunities hidden within those losses. Tax loss harvesting is one example. It's not flashy, it doesn't make headlines, but over time it can create meaningful value, and it's one of those many tax strategies at Synergy that we're looking at for our people on a regular basis. Think about in your specific situation. Do I have a taxable investment account? Is it volatile? Is it a diversified portfolio that's going to be volatile over time? And do I have an opportunity when that volatility comes to sell something, to trigger a loss, and then purchase something materially equal so that I can still have that market exposure, but I can take advantage of that loss? So here we are at episode 50, wrapping up our 50th podcast episode at Synergy Retirement Planning. I hope you learned a lot during these 50 episodes. If you have questions about the things that you've learned, the things that you learned today about tax loss harvesting, please feel free to reach out. At Synergy Retirement Planning, we help successful individuals and families simplify retirement complexity by coordinating investments, taxes, and legacy planning. If you want to learn more, go visit us at synergyretirement.com. Pick up the phone, call us, shoot us an email. Let us know, and we'll be glad to talk to you about your particular situation. If you like what you heard on this podcast, make sure you subscribe so that you're getting the most relevant, up-to-date information every Tuesday morning. They're letting you know that we've got a new podcast out so you can listen and learn more about your retirement. And until then, keep learning and keep growing.
Thank you for listening to Retirement GPS, navigated by Zynergy. To explore today's topic further, visit our blog Mile Markers at zynergyretirement.com/blog, where we offer detailed strategies, examples, and downloadable tools to support your retirement journey. Follow us on LinkedIn, Instagram, and Facebook at Zynergy Retirement Planning for weekly insights, checklists, and planning reminders. If you found this episode helpful, please subscribe, leave a 5-star review, and share it with someone planning for their future. Until next time, keep navigating toward a confident retirement. This podcast is for informational purposes only and is not intended as investment, legal, or tax advice. Listeners should consult their own financial, tax, and legal advisors before making any decisions. Zynergy Retirement Planning is a registered investment advisor located in Red Bank, New Jersey.